The highest rates of inflation in nearly a decade has got investors worried about the future outlook of their investment portfolios. Could this be one of the UK's toughest economic issues that we've experienced since the financial crisis of 2007, which could result in lackluster returns for the foreseeable future? Well, in today's video, I wanted to share with you guys how you could potentially navigate a pretty rocky road ahead with potentially high levels of inflation in order to not only protect your wealth but grow it over time too. But before I do so, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below, as well drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So I'm going to structure today's video by firstly talking about the problem of inflation, and then we're going to talk about how central banks can potentially go on to solve it, and then finally we'll talk about how you can beat inflation regardless of the circumstances. So first up, the problem, the silent killer, also known as inflation. Over here in the UK, inflation figures have just hit 4.2% for the month of October, which is the highest in nearly a decade, and over in the US, they've got it even worse at 6.2%, the highest in 30 years. But the question is, what has actually caused the global increase in prices? There are two main factors in which I wanted to discuss with you guys, and the first one is cost push inflation. It's where, thanks to an increase in raw material prices, labour shortages, and global supply chain shortages, the prices of goods have increased. Shipping container prices are up 400%, the price of fuel is up 25% at record highs of over £1.50 a litre, and now there's talk about even being a goddamn Christmas turkey shortage because of a shortage of HGV drivers. But it gets worse because the other factor in which I want to talk about, which is probably the most problematic one, is demand pull inflation. Thanks to a ton of monetary stimulus over the course of the past 18 months over in the United States with the Federal Reserve printing money, and with the UK very much following suit, it certainly left us in a bit of a financial shit show. The Fed have been printing money like it's going out of fashion, and due to that, the money supply has grown exponentially over the course of the past couple of years. And that's why we're seeing more extreme numbers over in the US as opposed to that as over in the UK, because we haven't taken all of this monetary stimulus stuff to quite the extreme. But when you combine a scenario of both a cost push as well as demand pull inflation all at one time, you find yourself in a high inflationary climate which isn't all too great for investors. Right now, interest rates are at all-time lows in order to help stimulate the economy, of which the byproduct is inflation. And because interest rates are typically so low right now, then you pretty much have no other choice but to actually invest your money. Because if you don't, well, your money will simply be eroded by inflation over the course of time as your purchasing power decreases. And this is where central banks will inevitably at some point have to step in, which is where we're going to now talk about the solution to the inflation problem. But firstly, let's talk about what happens if it's not actually solved. Well, we could end up with something called hyperinflation, kind of similar to what happened in Germany just after World War I, where inflation was literally in the millions of percent, where money became so worthless that kids played with it as a toy rather than use it to spend it on sweets. Now, of course, whilst we're absolutely nowhere near those kind of inflation levels right now, it is certainly a snowballing effect, and if it's not stopped and not reined in, it could be a problem that does get out of control. So how do central banks reverse the inflation problem? Well, the simple answer is they'll likely increase interest rates. And if you increase interest rates, it reduces the amount of borrowing taking place and encourages individuals to stop spending so much money and start saving it instead. Sounds fair enough, but how will this affect your overall investment portfolio? Well, if interest rates go up, just like individuals are encouraged to stop borrowing and start saving more money, the same goes for businesses in which you're investing in too. They stop borrowing money to facilitate future growth, and instead they sit on more and more cash in order to pay back all of the financial obligations in which they have, driven by the fact that interest rates have gone up, and therefore those financial obligations have now become somewhat more expensive. And if a company's growth slows down due to the fact that they're not reinvesting as much back into the business, then typically earnings then go on to fall, and as a result of that, then the stock price tends to fall with it. It's of course a very sticky situation for any investor to navigate their way through, but with inflation rates being at kind of decade or multi-decade highs over in the United States, it kind of just seems inevitable that central banks will certainly look to have to take action and start hiking interest rates really soon. I guess the only real saving grace for us as investors is the fact that interest rates, as I said, are at historical lows at just 0.1% over here in the UK is the Bank of England base rate. So because of that, even if we do go on to hike interest rates, possibly 25 basis points or the equivalent to 0.25%, it's probably not quite enough to make a material difference to the potential businesses in which we're investing in within our investment portfolios. But having said that, let's say we then enter into a bit of an environment whereby interest rate hikes continue to happen on a more regular basis in order to curb that of inflation. Well, in which case there are probably two different things in which I'd focus on within my own investment portfolio. The first thing is assuming that we're still very much talking about the short term and we're still in quite a high inflation climate, then the first thing that I'd be focusing in on is the actual real rate of return on my investments. The reality is we've seen pretty spectacular returns over the course of the past 12 months for the S&P 500, which has returned 30% to investors. Now, for context, the average annual rate of return for the S&P 500 is only about 9 to 10% per year. So the returns in which we have been getting over the course of the past 12 to 18 months are certainly somewhat unprecedented. So thinking about stock market outlook for 2022, let's say into next year we still end up in an environment where inflation is still quite high. If interest rates slowly start to increase, we could very much end up in a scenario where business growth starts to slow down and therefore stock market returns slow down too. Due to this, let's say we end up in 2022 seeing, I guess, more average returns for the stock market, returning probably about 9 to 10% per year instead. If in the event where inflation is still 4, 5 or 6%, the actual real rate of return on investment portfolios is probably only going to be between 3 and 4%, which the likelihood is for most investors out there, that's probably not going to be enough return on investment in order to meet the financial goals in which you have. The only saving grace for investors right now is the fact that yes, we obviously are seeing very high levels of inflation, but we're also seeing extremely high returns in the stock market, so those real rate of return, so to speak, somewhat feel very, very high. But like I said, if we end up in an environment where inflation's high but interest rates also start to creep up, then that will certainly hinder the performance of some of the potential growth stocks in which you have within your investment portfolio. So because of that, we've got to start to think about potential alternatives that we could possibly look to invest into, which kind of takes me down the thought process of looking to invest into consumer staples. The reason being that consumer staples sell all of the essential products that consumers need, from food and beverage to household goods, hygiene products and alcohol and tobacco. All of these goods are absolutely necessities that consumers will continue to buy regardless of the price of them. You probably could have put the price of toilet roll up to £20 a pack during the height of the pandemic and people would have still clawed it off the shelves, but that's another topic for another video. But in terms of investment returns, obviously the companies that operate within the consumer staples industry swallow up inflation within the price of their products. Due to that, their revenue and earnings are typically unaffected by that of inflation, and therefore can certainly provide some stable stock returns during what could be very uncertain and unsteady economic conditions. To find out more about the different stocks within this space, you can go onto an app like Trading212 and search for consumer staples. It will show you all of the stocks that appear within this category for you to research in a little bit more detail. So beating inflation, of course, it's been very easily possible over the course of the past 18 months, and in my opinion anyway, whilst market returns might not be as phenomenal as they have been most recently over the course of the next couple of years or so ahead, in my opinion anyway, beating inflation will be very, very easy just simply by investing into the stock market. For me personally, my own strategy will be simply to continue to invest into the stock market regardless of economic conditions, because if I'm ever in doubt, I'll just go on to look at the long-term trends of the stock market and then realize it was the reason why I got started investing in the first place. Always keep your long-term investing mindset hat on and certainly don't get scared out of the market due to all of the fear-mongering over in the media and the economic uncertainty that's probably going to come about over the course of the next 6 to 12 months. So with that said, guys, I do hope you enjoyed this video. If you did so, be sure to drop a like on it. Consider subscribing to the channel as well if you're new around here. And with that being said, I'll see you over in the next video.